long as you stand by me. And
Good morning and a warm welcome to all our attendees today. It's an honor to have you here, and we are thrilled to be at this webinar today. This webinar will be scheduled for 1 hour and 30 minutes, and we encourage you to stay to the end. It promises to be a great time, so please stay engaged to the end. My name is Ngozi Maduka, and I work with Apel Asset Limited. Apel Asset Limited is your one-stop financial services provider. We are located at Ikoyi. Our firm comprises of 3 business names: Apel Asset Limited, which offers our stockbroking and financial advisory services, and Apel Capital and Trust Limited, which offers our trust services and wealth management services. We also have Apel Capital Registrars Limited, which offers our registrars and investors relations services. Before we dive into our discussion today, let me quickly go over some housekeeping rules. Participants are required to mute their audios upon entry into this meeting. We encourage participants to use the chat box for questions, for observations, and for their comments during the course of this training. If you encounter any technical issues, our technical team is available to answer you at any time. Please use the chat option for such inquiries. Today's webinar is titled Investing in Resilience, the Value of Hope. And we are honored to have Mr. Teslim Shitta-Bey as our esteemed speaker. A quick profile review of Mr. Teslim. Mr. Teslim has established himself as a prominent figure in both financial journalism and investment banking over the course of his career, spanning more than 3 decades. He has his bachelor's and master's degree in economics. Sorry, one moment, let me just share his profile so we can all follow through. Okay, sorry. Okay, here we go. Mr. Shitta-Bey is a prominent figure in both financial journalism and investment banking for more than 3 decades. And he has his master's and bachelor's degree in economics and statistics. He has over 20 years in experience in investment banking and financial reporting. He commenced his professional journey at Capital Bank Limited, where he served as the head of the corporate finance and research group for 5 years. Mr. Teslim has been in many other significant transactions in the market as we know it. The first of which is Lagos State Government 50 billion revenue bond and equity flotation at the defunct now African Petroleum PLC. He later transitioned to City Express PLC as the head of corporate finance group, contributing projects including the fixed income debt origination for the Ekiti State Government 4 billion revenue bond. In subsequent roles, Mr. Teslim worked at Capital Express Securities and Grant Alstom Consulting. Mr. Teslim demonstrated his expertise in capital market mandates and financial consultancy, as he is actively also engaged in professional committees, such as the Chartered Institute of Bankers of Nigeria Strategy and Advocacy Committee, and the Nigerian Economic Summit Group Advocacy Committee. Currently, Mr. Teslim is the Director, Chief Economist, and Managing Editor, at ProShare Nigeria Limited, where he plays a vital role in shaping the digital financial information landscape. Before we welcome Mr. Teslim to this webinar for today and to our discussions, I would like to share that as investors, as citizens of this country, you can thrive amidst the current economic challenges, and we are delighted to have you here once again. Mr. Teslim, without any further ado, I would hand over the floor to you. Mr. Teslim, the floor is yours.
Thank you very much, Ngozi. Thank you for a very warm welcome. It's quite flattering to have colleagues, mention you in light of conversations such as this. But I would also like to quickly say that we are having this webinar at a period of time that is sober for many of those in the financial services sector. The unfortunate passing on of Mr. Herbert Wigwe, the group the group CEO of Access Holding, and the passing on of Mr. Abimbola, who also was who also was at a point the chairman of the Nigerian Exchange Limited. I do want to wish their souls peaceful rest, and I do want to also hope that those they left behind will have the courage to continue their excellent works. Like I said before, it is a very sobering moment for many of us in the financial services sector. However, as those who are in creative arts say, the show must go on. Those of us who are alive need to continuously hold these exceptional men in our hearts as we continue to expand the scope of the excellent work they did while they were on earth. So thank you very much, everybody. Now, I would like to share my slides so that we can commence in earnest. I hope everybody can see my slides.
Yes, we can see your slides, sir.
Okay. Like you rightly pointed out when you were doing the introduction, the principal area of conversation today is investing in resilience. The
Sorry,
value
Mr.
of...
Teslim.
Yes, hello, can you hear me?
Can you please place the slides in slideshow?
Yes, that's exactly what I've done. Is it in slideshow now?
Not yet. I think it's loading up. Okay, still loading. Not yet, sir.
Okay. Because I've actually shared in slideshow format.
You can continue, sir.
Oh, okay, right. So like you said, the topic of the conversation this morning is investing in resilience, the value of hope. Now, one of the things I do want to say is this has no political connotation whatsoever. It's basically an expression for us to understand that in the very midst of difficulties, there are always opportunities. And what is important for an investor and an investment community is to always identify the opportunities that occur despite the headwinds that we see. Money is good to have, but is it very good to have money in a savings account in an environment of high levels of inflation, slow growth rates, and huge amounts of public sector debt? Those are some of the issues we'll talk about as we go along. Because currently we're beginning to see the impact of high levels of inflation on the value of investing and savings. And we'll look at what can you do to provide an opportunity for you to hedge against the adverse consequences of inflation on your earnings. The way it is now, using the rule of 72, the average 100 naira note in your pocket will be worth half its value in less than 2.5 years. And that is a scary thought. And we're already seeing that in the way prices have begun to adjust themselves. Let's just look at the price of a carbonated drink. I won't mention any particular name. A year ago, you would perhaps spend 150 naira to buy that drink. Today, you will perhaps have to spend 300 naira to buy the same drink. So you've seen a 100% increase in the value of that. Now, to make it come home, when you go to a construction site, you'll find out that most of those who work in the construction site take carbonated drinks and they'll take a loaf of bread. So if you use 2023 as a benchmark, January 2023 as your benchmark, and you looked at the impact of inflation on the construction workers' ability, therefore, so to say, using a Nigerian parlance, what would be that impact? The impact would basically be that 100% of the value that he used to spend on the collective item to keep body together, as we say in Nigeria, has been lost. The same applies to investors also. So is all hope lost? Perhaps not. Can we redeem our portfolios? Perhaps yes. How? These are the issues that we'll discuss during the course of our conversations this morning. Now, I'm going to talk about 5 basic things. And there are 5 areas of conversation for me this morning that I consider extremely important. The first is diagnosing the Nigerian economic landscape. What kind of creature is the Nigerian economy? And where is that creature heading? Another point is cash holding and investment options. What should we keep our cash in at the moment? Like I had said earlier, savings is perhaps a no-go area at the moment. Even though as a moral construct, savings is a good thing to do, but in an environment of rapidly rising inflation, it has consequences. And so we have to look at that. Then the third thing I want to establish is the key investment options. What options are available for those in the low income bracket, the medium income bracket, and perhaps in the higher income bracket? Again, in an environment of rising inflation and slowing economic growth, the consequences of risks becomes even more severe. And that is mainly why, at this moment, risk becomes a crucial element in the investment decision-making process. And I'll give a few closing thoughts as the 5th element of what I'll be discussing today. So let's start the conversation. Let's start the village square discussion. Let's start insights into the Nigerian economy. Now, to grasp Nigeria's condition in a rapidly changing global, continental, and national context, we must understand the shifts occurring in geopolitics and geoeconomics. The Nigerian economy is not an abstract construct that just hangs loosely in the air. It's part of a global economic system. And it is important for us to understand how Nigeria positions itself within this global economic context. Let's look at geopolitical issues. Currently, we see that there are difficulties between Russia and Ukraine. There are difficulties in the Middle East between the Gaza Strip, the Hamas, and Israel. There are also other more closer conflicts that will have compelling consequences for the Nigerian economy. And I'm talking about the recent decision by 3 African countries to exit membership of the Economic Community of West African States, ECOWAS, and create a new sub-regional body called the AES. Now, the AES is made up of Mali, Burkina Faso, and Niger. Niger is just at the top of Nigeria. The other 2 countries also are at the top of Nigeria, and therefore have economic impacts on the way the Nigerian economy will evolve going forward in the sub-region. Now, the next slide I hope you can capture is something I want us to look at in a way for us to grasp a deeper understanding of how the geopolitical relationships are reshaping and redefining the world we live in today. Let me give a typical example. We talked about the AES. The AES was part of ECOWAS, which itself was a part of the African Union. Now, members of the AES have mooted the idea that they will form a closer economic bloc. Now, that closer economic bloc also has political consequences. For instance, there had, over the last 2 weeks, been suggestions that these 3 countries may decide not to allow Nigeria make use of their airspace. Now, let's just use that as a case use example. Nigeria not being able to use these countries' airspace means that Nigerian airlines or airlines that operate from Nigeria will need to circumnavigate these 3 countries to be able to go to places like Europe. What does that mean? That means that more fuel consumption, longer travel hours, and several other consequences from having to consume more fuel as a result of the decision of this newly created economic bloc. Nigeria will definitely need a response if this pans out to be a reality. I will not discuss details of that, but it is clear that these shifting global economic trends are showing that there will be consequences for the Nigerian economy. Yes, I can. Could you kindly put this on the Nigeria's economic landscape, and you can broaden out that ecosystem I put there. There's an economic ecosystem that I would like our viewers or our participants to see, and we'll see the consequences of that ecosystem on Nigeria and on Nigerians. Yes, could you shift it to the left from my side? I'm looking at it from, it's more tilted towards the right. Now, anyway, I'll continue my observations here. There's another economic construct called BRICS. BRICS is made up of Brazil, Russia, India, and China. They've just recently brought in one African member. You had South Africa already there, but you now have two other members rather. You have Egypt and you have Ethiopia. Why is that important? Well, first and foremost, Egypt has some of the largest banks in Africa positioned within its borders. In other words, some of the largest banks in Africa reside basically in Egypt and in South Africa. Indeed, the top 10 banks in Africa, 8 are in these two countries, Egypt and South Africa. Ethiopia is important because Ethiopia is one of the fastest growing economies in Africa. The Ethiopian economy is projected to grow at a rate of 6.8% in 2024. Other countries, like the AES countries, are also expected to grow at a rate of above 6%. Burkina Faso is expected to grow, yes, better, that's much better, thank you. Burkina Faso is expected to grow at a rate of 6.2%, while a country like Niger is expected to grow at a rate of 6.4%. So that suggests that the fastest growing economies in Africa are outside the economic orbit of Nigeria. And that has consequences for the ability of the Nigerian economy to grow. Don't forget, last year, the Nigerian economy in the first quarter grew by a rather modest 2.31%. That grew in Q2, the second quarter, to 2.51%. By third quarter, we saw the Nigerian economy grow by 2.54%. Now, projections from different international agencies suggest that Nigeria's economy will grow by 2.9% in 2023, that it was about 2.9%, and that it will go by 3.1% in 2024. Approach we disagree with these calculations. Now, one of the reasons why we disagree with the fact that the Nigerian economy grew by 2.9% in 2023 was the fact that for it to do that, it meant that in the last quarter of the year, it must have grown by 4.14%, which we believe it did not do. So the growth rate, the average growth rate for the Nigerian economy in 2023 will be closer to 2.6%. But when you compare that to the over 6% in Niger Republic, the Ethiopian growth rate of about 6.2% this year, maybe 6.8%, 6.2% last year, and about 6.8% in 2024, we are far behind in terms of our pace of growth. And therefore, these economies are, as far as we in ProShare are concerned, important to understand how Nigeria can collaborate with them to actually improve the pace of growth of its own economy as well. That being said, we can move on to look at the Nigerian economic dashboard. Now, looking at the Nigerian economic dashboard, we see that inflation as of the end of Q3 2023 was 28.92%. That was up from 21.47% in December 2022. Now, the most frightening thing was actually food inflation. Food inflation by the end of 2023 was a staggering 33.93%. And that's up from 24.13% in 2022. And the real elephant, or is it bull in the China shop, is the exchange rate. The exchange rate as of December was 907 naira to a dollar in the official market. But as of today, I think we are all aware that the official exchange rate is above 1,500 naira per dollar. That suggests a very staggering increase in the exchange rate. And we feel that the exchange rate throughout 2024 would largely reside within these areas. But that's a bit surprising for us at ProShare. Why? We were one of those who were heavily supportive of a regime where we tried to remove restrictions on the exchange rate market. Now, our early thoughts on this was this, that by removing restrictions on the exchange rate, we expected to see the official market deteriorate. We expected to see the BDC market appreciate. And therefore, we saw from our own models that there should be some kind of harmonization of the two rates around 950 naira to 980 naira to a dollar by Q1 2024. However, that hasn't panned out. So that shows that economists can't get it wrong. But what we did get right is that there seems to be a harmonization. So both the official exchange rate and the BDC rates currently are around 1,500 naira per dollar. However, the real question is, does this suggest that we have gotten to a point where the value of the naira reflects its true value relative to the dollar? These are subjects that we can have a conversation around sometime, maybe later in this presentation, or maybe through questions on the chat room. Right, now, unemployment rate in Nigeria. The Nigerian Bureau of Statistics changed the basis for assessing unemployment. So from 33.3% that we saw at the end of December 2022, unemployment rate fell to 4.2%. However, we need to be very careful with these figures. Being careful with the figures suggests that the methodology of calculation of unemployment rate in 2023 was different from the methodology of the calculation of unemployment rate in 2022. Therefore, it would be wrong to suggest that unemployment rate between the 2 years fell by 87.39%, as would be the obvious logic by seeing that unemployment fell from 33.3% to 4.2%. But the two figures are not the same kind of animal or creature. One is based on a calculation that is homegrown. The other is based on a calculation that is advised by the International Labour Office, the ILO. But I do wish to say here that unemployment rate obviously has risen, and for reasons perhaps everybody here knows. We've had a slowing of growth of the gross domestic product. We have seen a rise in inflation rates, and the rise in inflation rates has reduced real disposable income of Nigerians. And that in turn has meant that factory inventories have increased. PMI, that is the Purchase Managers Index, has actually fallen. So we've seen PMI below 50% at a point within 2023. And it declined for 2 consecutive quarters. So it does suggest that output is not as fast as in the past. And if that is the case, then we expect unemployment to have worsened. And of course, don't forget that in the first quarter of 2023, we had the currency challenges as a result of the change in the currency from the old currency to the new currency, and all the problems associated with that created massive supply side disruptions in the first quarter of 2023. And so we expect that the economy would have definitely slowed down, and employment also would have slowed down significantly in the first half of 2023. So we feel that the unemployment figures are a bit touch and go. The same goes for the underemployment figures also. But one interesting thing is that the misery index seemed to have fallen from 54.77% to 33.12%. Now, that is also influenced by unemployment, because part of the misery index includes the unemployment figures, and therefore the reduction in the misery index might be highly exaggerated by the improvement, so to say, in unemployment. Now, interest rates between 2022 and 2023 rose. We saw interest rates rise from 16.5% to 18.75%. Now, interest rates here, we're actually talking about the monetary policy rate. The rate rose from 16.5% to 18.75% with a number of consequences. What it suggested was that the Central Bank of Nigeria was increasingly tightening its monetary policy. In environments of tightened monetary policy, there's a slower growth in the economy, and a slower growth in the economy usually translates to rising levels of unemployment. And that's why we are very careful about the use of the unemployment numbers that you can see on your screen. Now, we looked at the credit to the private sector. Private sector credit actually rose between 2022 and 2023. Credit to the private sector rose by 40.39%. The reason was that there was a slush of money available in the system, and money was available for private sector use. However, the problem was that even though there was an increase in money, there was a reduction, and a significant reduction in the value of the money that was being supplied because the exchange rate had started to deteriorate. So you needed more money to actually import units of goods from your various countries of import. Now, here you see the PMI figure that I talked about. Here in December, it was 53.6, and it fell to 52.7. But actually, within the year 2023, the PMI actually dropped to 48.7% within that period. But this is the average for the period. But within specific quarters, we saw PMI actually drop below 50%. And like I said, GDP growth fell in from December 2022, where it was 3.54% to 2.54% in December 2023. Now, external reserves, another bull in the China shop, which we'll have a conversation over later in the course of this analysis. It's obvious that the external reserves has been declining between December 2022 and December 2023. We saw a decline of about $5 billion. Now, let's take a quick look at some other key indicators. We look at crude oil production. Crude oil production rose marginally by 5%, from 1.1 million barrels per day to 1.34 million barrels per day. However, let's note something here. The OPEC quota for Nigeria was 1.7. It's about 1.76 million barrels per day. And Nigeria could not produce that quantity. And currently, we are still stuck at about anything between 1.4 and 1.5 million dollars per day, which is still below the previous OPEC quota apportioned to Nigeria. What that means is that we are not generating enough foreign revenue flows. And that will have significant impact in our exchange rates. Why is the exchange rate so important? Nigeria is a heavily import-dependent country. We rely heavily on importation. And therefore, anytime the exchange rate moves adversely against the Naira, we begin to see the prices of domestic products increase, including with the retail price of PMS. Yes, we have seen some stability in the retail price of PMS recently. We are looking at about anything between 610 to 615 Naira per liter. However, what that means, based on the template, if we use the current template, is there is actually a subsidy component of the existing, based on the landing price of PMS and the retail price that a PMS is sold, we quickly see that there actually is still a subsidy component. And that belies the original purpose of the Mr. President deciding when he came into office to immediately remove subsidy on retail price of petrol. And the consequences of this for fiscal stability are the same as they were over the recent past, which means that a lot of the money that should have gone into infrastructural investment has actually still been used to support a steady price for PMS. Now, Another important thing we need to note is Nigeria is in a debt vortex. We have a very heavy debt burden, which will continue in 2024. Nigeria's debt size rose from 30.3 trillion naira in December 2022 to 46.92 trillion naira by December 2023. In other words, there was a massive 16 trillion naira addition to debt. That is not likely to reverse anytime soon. And here there is a problem as well as there is an opportunity. We'll go into that conversation as we proceed with the webinar. But I do want you to realize that it is important for Nigeria to squarely address its debt issue. Not addressing the debt issue suggests very difficult challenges for the fiscal stability of the country in 2024. People have made statements like, it's hard, but it's going to get harder before it gets better. It's a painful statement to make. It does seem pessimistic, but then again, the whole essence of this webinar is to suggest hope. It isn't a hope that is political, it's hope that derives from the opportunities that will emerge from the current state of the market, the financial market and the real sector of the economy. Now, in the slide here, you see the rate of growth of the economy. We've seen the economy continuously drop, especially from Q2 2021, where the economy was growing at 5%. By the end of 2021, growth had dropped to about 3.1%. And 2022, growth fell in the third quarter to 2.25% before rising again to 3.52% in the last quarter. Now, one of the lowest periods of growth was 2023, last year, where the economy was really squeezed as a result of monetary policy tightening, fiscal policy looseness, and some of the fiscal measures taken by government. Could you quickly move to the next slide, please? Right. Now, as a result of the tightness of the economy, the singular most important unit of the economy, the household, was knocked for six. The Nigerian household had to suffer severe tightness and readjustment to the economic environment. Because of that, we began to see what we at Project call the sachetarization of the Nigerian economy. Everything started coming up in sachets. So you had sachets for everything. You had a sachet for a toilet cleaner. You had a sachet for cooking cubes. We had a sachet for baby food. We had sachets for energy foods like, but I didn't want to actually mention the name, but just to make it more down to earth, something like Milo. So Milo started finding that sachets were a faster growth market than the tinned mirror market. And so we started seeing cornflakes, Milo, peak meal. We started seeing a combination, even palm oil became in sachets. So in 2023, as a result of the severe consequences of a 28.93% inflation on the incomes of households, people decided that the best way to provide goods for that market is to make them in smaller packs. So the Nigerian economy in 2023 became sachetarized. And that, we believe, will be a trend that will still continue in 2024. But don't forget, that had already been a trend we saw in the drinks market, where gin and some other varieties of drinks had already converted to sachetarization. And that served as a massive growth opportunity for them, especially at the lower income retail market. That will continue to grow. Now, another aspect of the Nigerian economy that we need to take notice of is the rate of growth of the different sectors of the economy. The fastest growing sector of the economy in 2023 was the finance and insurance sector. The finance sector grew by 28.21%, water supply sewage by just under 12%, information and communication grew by just under 7%. I think it was 6.69% actually. And then interestingly, coming fifth in terms of, or fourth in terms of order of growth we saw the arts and entertainment sector grow by just under 5%, actually 4.45%. That's the point we will come back to in terms of opportunities. And a concept I will introduce here that I call the smile curve. Now, entertainment is an area that Nigeria needs to take more seriously. More seriously, not only from the perspective of employment, but perhaps more critically from the opportunities in foreign exchange generation, as well as opportunities to ensure slower growth in domestic inflation. I'll tell you how all that links up shortly. The construction sector in the third quarter of 2023 grew by 3.89%. Now, other sectors grew at different percents. But what was more interesting for me is that despite the fact that between 2022 and 2023, we had spent massive amounts of money in the agricultural sector and to support farm sector growth, we actually saw an agricultural sector grow at a very humble 1.3%. So how is it that so much money is spent in the agricultural sector, but so little growth is seen in that sector? Those are things we need to talk about. And then the manufacturing sector grew at less than 0.5%. In other words, less than 0.5% in 2023. For us, that's a matter of great concern because manufacturing is important for the purposes of employment and for the purposes of indigenizing knowledge, technical knowledge on production, how to produce things to scale. Now, without a vibrant manufacturing sector, you're most likely to see an environment where you are a perpetual importer of final goods. And that is exactly what we don't want. But we can see why we are having problems already with our foreign exchange market, where the manufacturing sector is growing by 0.48%. And then another sector that also is of importance and interest to us at ProShare as researchers is the mining sector. Nigeria is known to have several world-class mineral resources. In other words, mineral resources that global manufacturers prize. For example, lithium. Lithium is in abundance in the north-central area of Nigeria. What about gold? Gold also exists in the southwestern part of Nigeria, Osun State, as well as in the north-central. Most of these materials are not being harnessed in a structured and constructive manner to enable us derive value from that sector. So yes, we have a mining sector, but the mining sector is predominantly unofficial. And so most of the value in that sector is actually exported with no official record. That is a problem, but it's also an opportunity, which means that if we get it right, if we provide the necessary governance structure around mining, we should be able to derive more global value, and we should see an appreciation in our exchange rate as a result of our ability to export mining products. Of course, for those who are familiar visitors to Dubai, actually there is a Nigerian state that's associated with a particular type of gold in Dubai. And so when you go to Dubai, they mention the name of that state as the acronym for that particular brand of gold. But if you look at official data, you don't see the volumes that leave Nigeria into those type of countries being reflected in our official export of mineral resources. And those are areas where the government needs to intervene and needs to harness to improve the official flows of FX. And of course, the worst sector for 2023 was actually the transportation and storage sector. These sectors actually shrank by between 35 and 36%. That also is a mark of the slowing down of the growth of the Nigerian economy. Because when the economy grows, transportation also grows. Because road transportation is still a major way by which goods are moved from different parts of the country. Now, let's look at the next slide, and we look at agriculture. Agriculture contributes almost 30% to gross domestic product. But flip that to the chart we saw earlier. Despite the fact that agriculture contributes about 1/3 to GDP. Growth rate in the agricultural sector is less than 2%. So it was far behind the financial services sector, far behind entertainment, which grew at about 4.45%. So there is a misalignment between the relative contribution of Nigeria's sectors and their growth rate. And therefore, we are beginning to see the consequences of a lack of alignment between between the different sectors of the economy and their contributions to GDP and the growth of the Nigerian economy. Let's go to capital importation. Now, yes, why is capital importation so important to the Nigerian economy? It's important because if you look at a country like India, last year India was able to attract $120 billion from foreign repatriation. In other words, Indians abroad repatriated over $100 billion to India. Before COVID-19, China had foreign repatriation of between $80 billion and $100 billion annually. Foreign repatriation to Nigeria had averaged about $20 billion annually, dipped after COVID-19 in 2021 to between $17 billion and $18 billion. But it does seem that modestly, there has seemed to be a more recent increase in repatriation of funds, but it is not sufficient to feed into the vision of a Nigeria that not only wants to, but needs to grow at a pace of between 8 and 10% per annum to achieve the laudable objectives of building a $1 trillion economy of Mr. President. So if you look at the figures on your screen, you'll see that foreign direct investment and foreign portfolio investment since 2019 has steadily declined. The worst decline was in 2020 for the obvious reason of COVID-19. So we saw a massive decline in FDIs and FPIs. However, 2021 continued that trend where we saw that FDIs and FPIs remained flat. Fortunately, 2022 saw a modest reversal of that trend, but 2023 saw a revision to a declining trend in foreign portfolio and direct investment. So foreign portfolio and direct investments for Nigeria between 2020 and 2023 have been very modest and, quite honestly, rather flat. Yes, could we go to the next slide, please? Right. Now, like I said, this particular webinar is looking at hope. We are looking at where are those opportunities and what will be the key drivers. So this slide perhaps captures it. We've seen a real sector GDP contribution of about 1/3 of the total GDP. In other words, financial services sector contributed that. Telecommunications, 7.74%. Construction, 3.89%. Now, when you look at real sector GDP growth at 29.66% for financial institutions, these financial institutions only contribute 3.97% to GDP. In other words, while real sector GDP growth for the financial services sector, which includes banks and insurance companies, that growth does not add too much value to real output of the Nigerian economy. So there's a distinction between the financial sector growth and the real sector growth. And therefore, a question mark is, if the real sector of the economy is not growing so well, how was it possible for the financial services sector of the economy to grow so fast? Especially when you argue that the financial services sector provides the engine oil by which the real sector of the economy grows. So the real sector of the economy has slowed, but the financial services sector has grown rapidly. So how did they grow? These are questions we need to interrogate for us to understand the relationship between the real sector and the financial sector. One of the things I need to also raise here is the fact that when you look at the Nigerian stock market as represented by the NGX, you find out that the NGX has grown steadily. It has grown rapidly. But the real sector hasn't grown at the same pace. So why is it that the financial sector has grown faster than indicators in the real sector of the economy beyond agriculture? Why is it that the NGX grew at 35% last year, actually 35.9%, but the real sector of the economy barely could do 3% growth? These are also questions we need to address our minds to as we go forward, because it's very clear that the financial sector does not mirror activities in the real sector. Okay, so I'll go to the second proposition I wanted to make at this webinar. Looking at holding cash and investing. Should you keep on to your cash? Should you hold your cash? Or should you invest it? Should you save it? Or should you invest it? So here, we've just done a simple schematic. Holding cash, what are the pros? Well, when you hold your cash, you have easy access to means of payments and settlements. Also, by holding cash, you have low risks. Non-holding fees. In other words, if you place your cash in any vehicle, those managing the vehicles will take fees for managing the cash you have on your behalf. So you don't have to pay those fees if you hold on to your cash. However, there's a problem. The problem is that if you hold on to cash, you perhaps get no returns. As a matter of fact, you actually get a negative return, because adjusting your cash value for inflation rate will mean that your cash loses intrinsic value the longer you hold it, the more value it loses. Remember what I had said earlier, using the rule of 72, every 100 naira in your pocket is worth 50 naira in less than 2.5 years. So if you keep that naira in your pocket, you lose value. And we're not too sure that that's the right thing to do, to hold cash at this point in time. So cash gives you low returns, loss of purchasing power, and high opportunity cost. What that means is that you have foregone the earnings that cash could have generated for you if you had placed it in an investment vehicle. What investment vehicle it should be placed in? Organizations like Apel will advise us on that. So before anybody, I want to head off any question about, oh, where do I put my money? Apel will answer questions about that. The only thing I'm prepared to say is that cash is not in at this moment. Keeping money in cash is absolutely unacceptable for those who want to protect the value of their assets. Cash is an asset, but it loses value as a result of inflation. So you want to protect yourself against that value loss as a result of inflation. So what about investing in stocks? Is that a good proposition or a bad proposition? That is perhaps like asking, is the cup half full or is the cup half empty? Like I said earlier, the Nigerian stock market, as represented by the NGX, grew by 35.9% in 2023. That's one of the highest growth rates for any stock market anywhere in the world. That's great, right? Well, maybe, because also when you look at the NGX, it's denominated in Naira value. And the nominal Naira value adjusted for dollars also declined by 35%. And so that was as at the end of 2023. Now it's even worse, because at the end of that period, we were still looking at 904 Naira or thereabouts to a dollar. But today we're looking at 1,500 Naira to a dollar. So the effective real dollar adjusted rate of returns for Naira equity assets are by far lower in real terms than they seem to be from just looking at figures like, okay, the market grew by 35.9%. Oh, that was wonderful. But a guy who is actually looking at the dollar equivalent is saying, so what? Because if I adjust for dollars, it's not as flattering as it does seem in Naira terms. But it does actually still provide you some protection against not having any return at all if you held on to cash. So the cons of investing in stock market is that there's a high risk, there's a high level of volatility, and there are significant transaction fees. My friends in Apel may not like that, but the truth is that the cost of executing transactions are still relatively high, but they are offset also by the fact that you can make significant returns if you have a carefully selected portfolio. I'll give you an insight into this. In ProShare, we have an index called the Tony Index, T-O-N-I, the Tony Index. Now, the Tony Index tracks all companies that are more or less investment vehicles for Tony Elumelu, the UBA Group Chief Executive Officer or Chairman. So we tracked all companies in which he has an investment interest, and we built an index around it. Now, if you look at the Tony Index, our Tony Index rose by 328% from January to December 2023. So if an investor had actually modeled his portfolio around the Tony Index, he would have done better than the NGX All Shares Index, like I said, which grew by 35.9%. But if he had decided, we have another index called the Gote Index, which, as its name suggests, is built around the companies where Alhaji Aliko Dangote, the chairman of the Dangote Group, has interest. Now, the Dangote Group index grew by about 34%. So the ASI All Shares Index did about 1% better. So if you had invested in the Dangote Index, you would have perhaps gotten a 34% return on investment by year-end 2023. Good or bad, depends on what side of the table you are on. If you are holding cash, it's still good. However, if you are deciding between two indexes, the Tony and Dangote Index, you perhaps have wanted to pivot towards the Tony Index. Now, in saying this, that does not mean that the Tony Index will be permanently yielding those kind of returns. We're just saying that fortuitously, in 2023, our Tony Index gave us over a 300% return on investment. So we can go on to, should we invest in debt instruments? The Nigerian government has shown a high level of consciousness of debt instruments. In 2023, the debt market was active because the government was also very active in that market. Well, it also depends on what side of the coin you want to be on. For some people, they like some amount of more secure investments, especially if you're an institutional investor with third-party funds. You're most likely to want to buy into the bond market. And if you buy into the bond market, you will get lower returns than you will get in the equity market. But then again, it's still better than holding on to cash. Now, so if you see if you take a look at the slide, if you take a look at the slide being shown on the screen, you'll see that cash gives you high liquidity, low returns, and has low risk. Stocks, they're most likely to give you moderate liquidity, high returns, and high risk. Bonds will give you low liquidity, moderate returns, and moderate risk. Commodities, low liquidity, high returns, high risk. Currency, high liquidity, moderate returns, but high risk. And we've seen the extent of riskiness of commodities in the way the Nigerian currency has fluctuated for the whole of 2023 and in the first 2 months of 2024. There's been a high level of volatility. Surprisingly, we got to a point where the official exchange rate actually rose above the BDC rates. And they rose above the BDC rates to over 1,500 Naira per US dollar. That had never happened prior to 2023 and 2024. We always assumed that the BDC rates would be higher than the official market rates. But the good thing about it is that it does show a narrowing of the premium between the parallel market premium. That is the adjusted returns you can get, the spread between what you would have gotten if you had bought FX from the official market and if you had bought from the BDC market. That spread is narrowing. and therefore the market is getting increasingly efficient. However, that level of equilibrium is happening at a very discounted rate of the naira against the dollar. So here, scenario and time horizons. We can get past this, but this hopefully the presentation will be shared. But you will see here how short-term goals and long-term goals become balanced. You do need some safe money. Now, safe money is money that you keep aside for emergency purposes. Now, what I've seen as an opportunity, especially for asset managers, is to create instruments that allow people to put money in emergency funds. So the money may not stay for too long, but it accumulates gradually and allows people withdraw those monies at times of emergency. One of the major problems we've seen in recent times in Nigeria is that people put money in short-term instruments, but find out that it takes a long time to actually use or evacuate those instruments from those assets and use them for the purpose for which you needed to use them, like a medical emergency. There are people that put their money in certain instruments. They believe that they can easily turn those instruments into cash and use that cash to settle certain emergencies like medical problems. But the opportunities here are slim. And I think that that's an opportunity for investment vehicles or investment companies or asset management companies to create those relatively short-term instruments that provides a lot of liquidity, but at the same time gives decent returns for cash set aside by investors. Now, in the medium to long term, there are several instruments. For instance, if you're looking at the stock market, a critical point is to see whether the stock market provides you a long-term opportunity, or are you trading? Because there's a difference between trading and investing. I think I need to establish that difference very clearly. Some people are traders and some people are investors. Now, the longer end of the market means that you're likely to go in when everybody is skeptical about a stock. Everybody is fearful about the market. Everybody is fearful about the economy, and stock prices keep going down. If you're a trader, you want to avoid those stocks. But if you're an investor, you're actually excited by the fact that true value is being reestablished. And Apel has certain projections concerning certain stocks, which I want to discuss here. But in their projections, you can see whether a stock is actually has hidden value. By hidden value, I'm saying that the stock is actually currently priced lower than its intrinsic value. And I don't want to talk too much here. I'm being a bit careful because I don't want to make any stock recommendation. But I do know that Apel has a Monte Carlo scenario analysis for each of the stocks listed on the NGX, and they provide insights into the discrepancy between the market value of the stock as well as its intrinsic value. Now, this is very critical to investors, and I'm using the word investor rather carefully, not a trader. A trader can go in and out of stocks regularly and make marginal gains from those in and out transactions. An investor has a longer term horizon and therefore is looking at keeping a stock for about a year or two before exiting that particular stock, when its price earnings ratio seems to be more realistic. Currently, many price earning ratios, I know of a number of companies who have price earning ratios above 150. Some have price earning ratios above 50. Now, it is nice to see those big figures, but do those big figures actually represent the future cash flows of those companies? From our calculation in ProShare, they don't. And therefore, they are overweight. Many of these stocks seem to be overweight. And like I said before, Apel also has a very interesting Monte Carlo model that I've seen, and I'm currently playing around with. And I think those who go to ProShare, those who go to Apel will be able to also benefit from these insights and select stocks that will yield them 1 to 2 or 3 or 4 or 5 year value, which will catch up and perhaps go in advance of inflation. Because what it means is basically this. if inflation is 28.9%, the minimum expected return on investment that you will require to even keep you where you are today in terms of value is 28.9%. A stock that doesn't give you both capital appreciation and a dividend yield of 28.9% is value destroying. Your value of your assets, which could be cash, will be destroyed if you cannot meet those minimum inflationary thresholds. Yeah, so let me quickly go to all-share index movements across selected markets in 2023. Now, if you look at the American market and you look at the S&P 500, you see that the market was relatively flat. The same thing happened in Germany, where you saw the DAX index showing more volatility, a tendency to rise in 2023 as the German economy began to move out of its deeply entrenched slow growth mode to a faster paced mode, which was also reflected in the faster rate of growth of the DAX index. That's one of the kind of thing we were talking about earlier when we were talking about the Nigerian equity market. The speed of the equity market growth should normally reflect the speed of the growth of the underlying economy on which that market is based. But for a variety of reasons, that has not happened. So the market has grown significantly faster than the underlying economy. But we can have that conversation somewhere else. If you look at the London market, the FTSE market, you find out that there was a high rate of volatility in that market. The rate of volatility in the market, in the FTSE market, that is the British market, was much higher than that of the American market. You can see relative stability and calmness in the American market. Now, one thing you will realize about the American market, inflation rate declined steadily throughout 2023 in America, from over 10% at the first quarter of the year. By the time the American economy had gone through the fourth quarter of the year, inflation rate was just above 3%, which was slightly higher than its long-term average rate of 2% per annum. So we can understand why there was a lot of calmness in the American market, and there was not so much fear about shocks in that market as compared to the British market, where inflation rate was equally above 10% in the first quarter of 2023, but has moderated since then, moderated also, but not as fast as the American economy. And so we saw in the UK market, the FTSE 100, we saw a heavy amount of volatility. Now, for traders, that was wonderful because it gave tremendous opportunities for traders to go in and get out of stocks at critical moments. That means you could get out, you could get in at troughs. That is when the stock prices are relatively low, and sell off at the top. Now, can you consistently play the market that way? Perhaps not. But in any case, it has proven to be a market of opportunities for international investors who have trading models that allow them to see the upsides and downsides of markets. Yes, so here we talk about what a difference a decade made. If you look at the capital market in 2013 and the market in 2023, there's some significant shifts. In 2013, the fixed income market and the currency markets were not as significant as they have subsequently become in 2023. Mutual funds and collective investment schemes were also not as prominent, but the equity market was the giant in the room. You had listed and unlisted markets being worth half the size of the total capital market. But in 2023, we started seeing a shift in the composition of the Nigerian capital market. So in a decade, the color and complexion of the capital market had seen significant changes. Collective investment schemes actually became more prominent. We also saw that because of activities of the FMDQ, we saw activities in the fixed income market and the currency markets taking off and becoming a significant proportion of traded transactions in the capital market. We also started seeing that equities market began to shrink. So it wasn't as, in 2023, it wasn't as prominent as it was in 2013, where it represented half of the capital market values. In this, here we see that as of December 2023, the NGX was responsible for 62% of the market, FMDQ 37%, and the NASD, the unlisted securities market, represented 1%. Now, debt size was about, for FMDQ was about 44.8 trillion naira. Market cap of the NGX, 75 trillion, and then the market cap of the NASD was 1.2 trillion. Could we go to the next slide quickly? Yeah, right. Thank you very much. So here we see the equity performance of the NGX. We can see what I had talked about earlier, that from the relatively low rates in previous years, 2021, sorry, from 2021, we started seeing some amount of upward volatility and upward movement in 2022, which spilled into 2023, where we saw a steady, less volatile, but steady upward movement in the NGX index. Now, here you see the Tony Angote index, ProShares Tony Angote index, sorry, and you see the values that I talked about earlier. We could slide past this, please. Yeah, so we'll see NTB yields. NTB yields were very volatile in 2023. They were flat between May and October, but had actually started climbing towards the end of the year before falling in December. And these are reflective of this demand and supply situations in the treasury market, as well as the tightening and loosening of monetary policy over the period of time. If you remember that the president came in May. From then, we started seeing some volatility in response to uncertainty about the direction of government's monetary policy. By October, we saw that the NTB yields had zoomed up as government's policies became clearer, and then it started coming down by the end of the year. I think that was a period of time when the government suggested that it will be less dependent on borrowings, and it will look for other ways of financing the fiscal gaps. The Nigerian currency market remains volatile, as we have discussed earlier. I don't think there's anything I would like to repeat there. We've seen that volatility, and that volatility comes as a result of challenges in supply side for FX. No matter how high the domestic exchange rate rises, there is not likely to be a cooling down of demand for FX because of our high levels of import dependence. So for the Naira to see appreciation, it would require that we look for supply side solutions. And those supply side solutions also opens up opportunities in the area of what ProShare calls financialization. The opportunity to take idle public assets, bring those idle public assets available to the market, and establish values for these assets. A clear example, let's take the National Stadium Surulere, for example. If we could find a way of, if we don't want to sell the asset, put it on a long-term lease. That long-term lease generates immediate dollar cash inflows. And apart from generating immediate dollar cash inflows, it creates an opportunity for the private investor in the National Stadium Surulere, which I'm using as a placeholder or as an example. It provides it the opportunity to improve the infrastructure and build an economic ecosystem around the stadium, where you can see various events taking place weekly. You will see further employment of Nigerians in activities around the area. We'll see supply chain improvements in terms of feeding. Those who have to watch events at the stadium will require food, and therefore this food supply chain is improved. So a lot of linkages to the economy. So the National Stadium Surulere, once the revenues become robust and the accounting of economic activities are transparent and fully established, there is absolutely no reason why that entity cannot be listed on an exchange. And once that entity is listed on an exchange, the government can therefore financialize its own proportion of the equity value in the National Stadium Surulere. We've seen that model work in Saudi Arabia, where the Saudi Arabian government listed the Saudi Aramco on the New York Stock Exchange. And we've seen the values. It's currently worth over $2 trillion on the New York Stock Exchange. And there's absolutely no reason why Nigeria's NNPC, for instance, can't attain a similar valuation over time, with a lot more transparency in its operations and a lot more value driven into the Nigerian economy and shared amongst the Nigerian people. Right, so yes, I talked about the fact that I want to address issues of risk. We've seen within the period several companies delisting. We've seen some companies leaving the country entirely. So we've seen JSK delist, we've seen Union Bank, we've seen PZ Cousins, we've seen Coronation Insurance, we've seen Owando indicate that it was delisting. Now, the underlying causes is that they've seen limited benefits from listing. They've also found it rather difficult raising capital through the market. They also perceive that the market does not give them an appropriate valuation, and that the cost of delisting is relatively low. So if it's low, why not just delist and buy out most of the minority shareholders? These are evolutionary developments within the market. But I am quick to say that we've also seen indications of large number of listings taking place. However, I would like to say something here. It's a matter of that we can all have a conversation around. The Nigerian government has continuously looked for plugging its fiscal holes by looking for debt, by looking for loans that it can use to plug fiscal challenges. However, we need to pay attention. As we speak today, there is no publicly associated company that is listed on the NGX. There's absolutely none. Now, why is that significant? As individuals, if I had, say, a Marubeni or a Lexus, top-end Lexus car, and suddenly I find out that I'm no longer liquid and I need cash, what do? I sell my assets. So I say, okay, you know what? I don't need a Marubeni. I perhaps sell it off. Buy a good car, but that costs much less. And then the excess money from it, I now use it to plug the gaps in my revenue. Now, as for the individual, so for the government. If the government had assets listed on an exchange, it could exit the exchange to sell down some of the values and use the revenues to plug some of the fiscal challenges it has. Because you cannot continue to look at the income statement of the federal government alone to solve the current problems of the national economy. We have to look at the statement of financial position, what we used to call the balance sheet. Currently, we just look at revenue and expenditure, which is an income statement. The government of Nigeria must increasingly look at the balance sheet and must look at its assets and liabilities. Now, this is the opportunity for the Nigerian capital market. It's the opportunity for investors to thrive. Why? Because Nigerians can now buy into the equity of utilities. For instance, why should I just be a consumer of power? Why can't I be an owner, a co-owner in the power infrastructure? Why must I just be a consumer of PMS? Why can't I be a part owner of the company that produces PMS? So why is it that I can only spend, which is on the P&L? Why can't I invest, which is on the balance sheet? So establishing the nexus between the income statement and the balance sheet statement is critical and is a great opportunity for the Nigerian economy to move at a faster pace and for Nigerians to derive true value from the economy in which they operate. Now, we have increasingly seen how banks have done futures, forwards, and swaps and how they have used it to gain significantly by net open positions in the foreign exchange market, such that if you look at the balance sheets of banks and their income statements, you see a heavy component reflecting the fact that they took positions concerning the naira and were able to get foreign exchange revaluation gains. It was good for the banks, maybe not so good for the economy. That's a matter for further debate. But the important thing here is that you can use financial market tools to hedge against adverse situations on your individual balance sheet. Every person, every institution has an income statement and a balance sheet statement. And therefore, some of the strategies that can be used for institutions can also be used for individuals. So foreign exchange hedging, interest rate hedging, equity hedging, all these are hedging methodologies. And I expect that it's an opportunity for companies like Apel Assets to be able to develop instruments that enable people to invest in such a way that they can hedge against swings or economic shocks. Right. So finally, on closing, could you pull up my closing thoughts, please? Yes, thank you. Yes. Hope, I have said, is a pathway to resilience. Hope is not a method. I re-emphasize, hope is not a method. What hope does is provide you some clarity over the direction you need to go to achieve your purpose. Hope, like I've said here, is a driver of positive outcomes. What hope does is that it doesn't let you, it lets you look into the sky and see the sun, and like an eagle, you soar. Rather than like a chicken, look at the ground and continue to peck at crumbs. That is what hope is about. Resilience is about our ability to withstand shocks, our ability to be creative, our ability to be flexible, our ability to be agile. Agility, creativity, flexibility will separate winners and losers in the Nigerian economy in 2024. As I said, the value of hope manifests in the confidence that well-managed portfolios can weather uncertainties, preserve capital, and capitalize on opportunities that arise amidst adversity. I re-emphasize, you can capitalize on opportunities that arise amidst adversity. You do not make money when everybody is making money, because it's very lonely at the top. You make money when everybody is despondent, everybody feels that the heavens have collapsed, and they sell on the cheap, and you buy. That's taking a strategic position. That's taking a position that shows faith in the resilience of the Nigerian economy. That shows that there is a tomorrow to which all of us can express hope. Thank you very much, ladies and gentlemen. Ngozi, I think you are muted. I think you're muted.
Oh, sorry about that. Thank you, Mr. Teslim, for this beautiful presentation. It was well delivered. It was very insightful. The points were very articulate. And so without wasting any further time, we will go straight to Q&A questions, which, sir, you would assist us in answering in 2 minutes. Here we have a question from Chidi Emenike. And he says, Mr. Chidi says, why is the FG projecting 1.9 million barrels per day, even though when it's obvious that it's far below that number? Then he also has a follow-up question. So are you taking that down?
Yes, I have.
Okay. He also has a follow-up question that says, about subsidy removal, recent revelations by IMF indicates that the federal government might have silently returned to the old practice of subsidizing PMS. If IMF report is anything to go by, why is average PMS price still high? Should I take all the questions or you answer as
No, you can take them in batches, yes.
all questions, then you answer? Okay. So Mr. Aderene Falade says, how do you think we can reduce the heavy dependence of our factories on Forex? He also has a follow-up question that says, why haven't they been involved in backward integration, such as assistance to farmers, etc.? Mr. Anthony Michael Akimole says, I think there's a problem in this economy. How can financial services sector grow by more than 20% while other sectors less than 10%, especially manufacturing sector growing by less than 5%? Mr. Olatunde says, there is a problem in this country, and he asks, what is the impact of financial and services industry on other sectors like agriculture and manufacturing? So what are the factors that propels growth in the financial and insurance sector? Something is not right. So I will leave you to take these questions for now.
Okay, let me start with Mr. Chidi, and he's talking about projections of 1.9 million barrels per day. Let me put it this way. All those who design policies are optimists. It's in their nature, it's in their DNA. You want to have, normally when you're asked, hello, can you hear me? Yes,
yes, I can hear you, Mr. Teslim.
Okay, so all those who design policies are optimistic. There are usually three models that are done. You have the pessimistic model, you have the most likely model, then you have the optimistic model. Those in charge of policy, almost by default, veer towards the optimistic model. So when they say that they're doing about 1.9 million barrels, it's possible to do 1.9 million barrels per day, we don't agree. We have not yet been able to deal with the challenges of oil theft. And in Prussia, we have done a very detailed research on the oil theft economy and why it is there and why it needs to be addressed. We did that report, I think, in early 2023 or late 2022. And it's obvious that the way things are today, it's very difficult for you to see a Nigerian economy that is going to be able to address its fiscal challenges without addressing the issue of oil theft. We have to really deal with that. Now, oil production has increased marginally. There have been measures taken by governments to reduce the incidence of oil theft, but we've gone far, but not far enough. For us to be able to hit 1.7 million barrels per day or 1.78 as OPEC had suggested, will require some massive amount of effort on the part of the federal government of Nigeria. And since I'm not an official of the federal government of Nigeria, I can't really talk too much on why they are so optimistic about it. They may have their plans, but what we are seeing is that we struggled to do slightly over 1.3 in 2023. As a result of improvement, we saw about 1.4 to 1.5, somewhere between 1.45 million barrels per day was what we actually produced. So escalating that by another 300,000 barrels per day or 400,000 barrels per day might be pretty difficult in our opinion. So that's what I can say on that. Now, to talk about what he mentioned on subsidy removal, there is really nothing anybody can do about it. The truth of the matter is that as long as we continue to import petroleum, there will be subsidies, unless the government is allowing the retail end of the market to every day, every week, change the prices of oil or PMS in the retail market. If you're not doing that, if you keep a relatively fixed price for an extended period of time, obviously the landing costs have increased as a result of devaluation of the naira. And so that devaluation immediately creates opportunities for subsidy. It's as simple as that. It's not voodoo. It's not straightforward. The oil comes in dollars and we're selling in naira. So as the naira depreciates, the retail cost of PMS and diesel and kerosene should rise. It's just simple. There's no advanced economic or statistical methodology to it. There's a template, and landing costs have increased. And because landing costs have increased, it's obvious that retail prices of PMS should increase. And if the retail price of PMS is not increasing, then somebody is carrying the can. Who's carrying the can? I can't say, but somebody is definitely carrying the can. That's for in response to Mr.
Hello, sir, are you there? Oh, it may seem Mr. Teslim has left the call. Please stay tuned. We'll try to get him back. We apologize for the delay. We are still trying to get Mr. Teslim on the call, please. Thank you, Mr. Teslim has finally joined the call. Mr. Teslim, can you hear us now? Oh, we can't hear you, Mr. Teslim.
Ali, can you hear me now?
Yes, we can.
Okay, sorry, there was a slight glitch.
Yes.
Yeah, so I talked about the subsidy removal, and I said, yes, there is a subsidy component. The subsidy component is inevitable. It's a part of foreign exchange. It's a part of the foreign exchange difficulties. There's very little anybody can do about that. If we want to remove subsidies, we need to see an appreciation in the value of the naira against the dollar. It's as simple as that. Perhaps maybe one of the things I didn't say in the course of the presentation was that when you see some of these economic blocks coming together, it's not just a geopolitical move, it's also a geoeconomic move. Geoeconomic in the sense that if you look at the BRICS countries, that is, you're basically looking at Brazil, Russia, India, China, and South Africa, now with Ethiopia and some other African countries, they're beginning to de-dollarize their transactions. In other words, they're looking for alternative currencies, perhaps the renminbi, the Chinese renminbi, to ensure that there is there's less dependency on the dollar as a tool for exchange consummation, that's trade consummation. What that does is that because they are depending less on the dollar, there will be an appreciation in the value of their currencies against the dollar, even though there might be a depreciation in the value of their currencies against the renminbi. However, if most of their goods actually come from the dollar, from a dollar source, then as the dollar appreciates, the cost of those imports fall. And although, of course, depending on the extent to which they are dependent on China, the values of commodities coming from China might also increase. But all in all, what we'll see is an improvement in the cost of goods entering those countries as a result of their decision to de-dollarize their imports. Now, I'm not saying Nigeria is going to do that. All I'm saying is basically that globally, nations are thinking of ways to improve the value of their currencies against the dollar, the US dollar in particular. So I hope I've answered Chidi's questions. Then I go to Mr. Falade, and he was looking at the dependence of factories on FX and the consequences of that. He was also looking at why are the financial services sector banks not integrated with the real sector of the economy? And these are very valid questions. They're questions that require deep amount of thinking. We expect that as the real sector of the economy actually improves, we should see an improvement in the real sector of the economy. The financial services sector should drag the real sector of the economy. However, we also need to look at the structure of the Nigerian economy. The structure of the Nigerian economy is such that does not make it real sector led. It's easier for me to make money in the financial services sector than it is to make money in the real sector of the economy. My break-even margins, and I'm trying to reduce the technical terms we are using here, is that what the profit margin on manufacturing becomes a bit difficult because there's heavy investment in fixed assets. A manufacturer will buy machines, he will buy inventory, that is, he will buy goods so that he can, maybe raw materials, so that he can change it into output that he can sell. In the financial services sector, I don't do such a thing. I have stocks, but they're not stocks of inputs that result into me creating a product that I have to sell. As a financial service, and it's like that globally, as a financial service operator, I simply have to leverage the knowledge and the contacts that I have to be able to generate funds for the real sector of the economy, or to simply create value of equity or debt. I can, for instance, as a person in the financial services sector, I can opt to work only in the fixed income market. I trade treasury bills, bonds, and do currencies, and I'm fine. For a manufacturer, it's not that easy. It's a lot more difficult. I think it's the same Mr. Falade that was talking about backward integration. See, backward integration has been a policy that's been adopted by some of the finest companies in the country today. And while I have restrained from mentioning names when it comes to companies, I will mention Nestle Nigeria. Nestle Nigeria has a large series of farms. They have a large network of farms that supply them with corn, sorghum, and the one other product, barley, that they use for their baby formulas. They also use some of those things for Golden Morn and some other products that they produce. And they did that in the early 2000s when Mr. Osunkeye was still the managing director of Nestle. He consciously decided that, look, it was about time Nigeria indigenized the whole production value chain of Nestle. And he pushed for that. And today, it's a winning strategy for them because there's less dependency on inputs in foreign exchange. Most of their products are produced in Nigeria, even through farm aggregator schemes, where like Babagona, where they come together, farms come together and provide them with goods. After they themselves have helped these farmers with seeds, improved seeds, and I helped them with fertilizers. And I've also helped them even negotiate funds at favorable rates to ensure that the farmer can actually invest in the seeds, grow the seeds, tender the farm, and sell to Nestle. So in other words, they have what we call a guaranteed market, an off-taker. They have a guaranteed off-taker. So they're not worried about volatility in their prices. The contracts are firm. And Nestle can do a 6-month contract with a farmer that, look, over the next 6 months, I'll buy this quantity of goods from you monthly at this price. And that helps stabilize the farmer and helps stabilize the farm ecosystem. So backward integration is something that some Nigerian companies have adopted. That's the point I'm making. And all we need is to see more companies adopt a similar methodology. I think we missed it when we did not continue to pursue the Buy Nigeria philosophy we had at a point in time, where we were insisting that you had to buy Nigeria. If we had consistently pursued that, raw material inputs for those companies that have even left Nigeria that we have seen in my earlier slide, those companies would have done the same backward integration. So baby diapers and nappies, most of the inputs would have been domestic. Drugs, most of the inputs would have been domestic. And so the foreign exchange shocks will be less severe on their books. And they will still make a tidy profit by continuing their Nigerian operations. But because they were heavily dependent on imports, putting a lot of pressure on the Naira, that is why we have the problems that we have now. And as far as the Naira continues to depreciate, companies like that have not integrated into the Nigerian economy will find themselves at adverse situations and will either have to leave or find creative methods of looking for alternatives in the domestic market. That's why I said there is hope. I'm not worried about these things because now companies will say, okay, if we have to deal with the Nigerian market, we have to look for raw materials in Nigeria. So by the time you're coming in, you're looking for Nigerian raw materials that ensure that you have solid domestic supply chains. What they have done before, yeah, so I think that that deals with that. Sorry, let me just quickly go to Mr. Anthony. He talked about misalignment of finance sector and the real sector. Yes, these are things we need to look at. I've raised those issues myself. It is what it is. The Nigerian economy is diversified. Nigeria's export earnings is not diversified. We are still heavily dependent on one particular product, and that product is oil. So unfortunately, it is what it is, like I said, until we decide to diversify FX revenue sources, we will still be locked in this situation that we found ourselves in. I think the agricultural sector, being about 25% of GDP, should take a more prominent role in generating FX. But that hasn't happened yet. And when we start focusing on such things as FX generating agricultural produce, then we should do a lot better in linking the exchange and the market. Because there are very few agri companies actually listed on the NGX. The big companies, there's no agricultural company listed on the premium board. So Mr. Latunde talked about the impacts of the financial services sector and other sectors. It's one of the themes I've been talking about, earlier in the day, where we noticed that there doesn't seem to be an alignment now. It is no fault of the financial services sector. You cannot blame a lion for being a lion. That's its nature. It's a lion. That's what it's supposed to do, to act like a lion. So the fault isn't this. The prospects and opportunities are that of the government at both federal and sub-regional levels to find alignments between the real sector of the economy, support those alignments between the real sector and the financial services sector. No financial services sector person will see an opportunity and pass it by. He will only decide not by default to fund that sector if he cannot see opportunity. But if the opportunities are there through schemes that would assure that my money will come back, because don't forget, the financial services sector person, a banker in particular, is using other people's money. He's using depositors' funds. Those funds have to come back. He has to, when the depositor asks for his money or her money, he has to give it back. And so he cannot afford to be reckless with other people's money. And so once we de-risk the real sector of the economy and improve supply chains, I am very sure they will begin to see those alignments that we all desire and hope for. Thank you.
Thank you, Mr. Teslim. Like I said earlier, this has been a very insightful presentation and answers to all our questions. But I have a few questions here. For choice of time side to be 5 minutes to respond to them. I have about 5 questions, so if you could help us to keep the time. Dahiru Usman wants your outlook on the exchange rate and inflation for 2024 and 2025. Afolabi Lukman, which is also a similar question, is saying the visibility of government achieving its target in 2024, considering we're in Q1 2024 and exchange rate is currently at 1,500. So I think it's a similar question we can answer in one question. Also, I have questions here from Mr. Odedino and Mr. Oluwaseun. Mr. Odedino wants to know what are the investable items under the commodities market in Nigeria. And Mr. Oluwaseun is saying here, what is the hope for us in small-scale farming? After this presentation, what is the hope for us in small-scale farming? And finally, I have a question from Mr. Goodwill Iyamu, and he wants to know if CBN can sustain this huge spike in NTB rates and the effect of it on commercial papers and the capital market. So, sir, in 5 minutes, so we can close the webinar, please. Thank you. You're unmuted, sir.
Yeah, I'm unmuted, Abi. Oh, okay, thanks.
You're muted, sorry, you're muted. Yeah,
yes, okay, thank you very much. Okay. All right. Thank you very much, Mr. Usman and Mr. Lukman. Exchange rate and inflation, very interesting questions. Inflation in Nigeria will be elevated throughout 2024. Exchange rate in Nigeria will also be elevated throughout 2024. It is what it is. These are the realities that we must face because the structure of the economy suggests that those rates will be there for some time. Will they improve? Yes, inflation rate will decline in 2024. Exchange rate will also improve in 2024, but there will be modest improvements. We don't see any major improvements happening in 2024 until 2025. Mr. Odenino talks about investable items under commodities. I'm going to leave that question for Apel. I'm sure they will get in touch with you and they will give you insights into those investable commodities. But I must say this, there are a variety of commodities that are doing very well in the international market. Some of the commodities from the North Central Zone have great market opportunities in Germany, France, and Spain. I think also there's opportunities in the Netherlands. Now, when it comes to some commodities in Osun, for instance, we do see opportunities in the Far East for one or two of their commodities that they can produce there, but they are mining commodities. In the areas of agricultural commodities, there are a lot of opportunities globally, but the forests are aging. The cocoa we are producing are also aging. We need improved seed varieties. There are arrangements to get that underway. I was in discussions within the week with the Development Agenda for Western Nigeria, Dawn Commission, and we had conversations over some of these investments, which that's why I cannot disclose them now. Mr. Goodwill Yamu talked about the NTB rates and are they sustainable? No, they are not sustainable. We will see changes in those rates. We will see movements. I do expect to see that the Central Bank of Nigeria at its next meeting, MPC meeting, will change some of the variables, the monetary policy variables, and that will result into changes in NTB rates. So yes, the NTB market at spike that is currently witnessed will not be sustainable. There will be changes. But then again, one thing I will tell you is that there will be monetary policy tightening. So rates actually will be high. And you know, there's an inverse relationship between fixed income prices and money market interest rates. So higher interest rates means that there will be lower bond prices, and therefore we expect yields to go up, at least in Q1 2024, and perhaps into Q2 2024 too. Thank you.
Thank you, Mr. Teslim. Thank you. Thank you so much for this answers briefly to our questions. It's been an honor to have you at this webinar. And as always, you have delivered and you have delivered well, sir.
Thank you.
So we want to thank everyone who has stayed to this end. We know I promised at the beginning that it would be a very engaging session, and Mr. Teslim has delivered on that, and we are grateful, sir, once again.
Thank you very much.
I know there's a question about commodities and how you can invest in commodities. Like I said earlier, Apel is your one-stop shop for all your financial services. We provide services that cut across the capital markets and money markets and also the commodities market. So our details are displayed on your screen. You can reach out to us via email at info@apel.ng. Even on Instagram, LinkedIn, Twitter, Facebook, we are readily available to respond to you. And you can go via our website to learn more about our company and the products and services that we offer. Thank you all for joining this webinar. Thank you, Mr. Teslim. And it's been an honor to host. My name is Ngozi. Thank you.
Thank you very much. Bye.
Goodbye, everyone.
When the night has come and the land is dark and the moon is the only light we'll see. No, I won't be afraid. Oh, I won't be afraid. Just as long as you stand by me. So darling, darling, stand by me. Oh, stand by me. Oh, stand by me. Stand by me. If the sky that we look upon should tumble and fall, or the mountain should crumble to the shed a tear, just as long as you stand by me. And darling, darling, stand by me. Oh, stand by me. Just as long as you stand